Joining me now for more is Michael Clarfeld, portfolio manager at ClearBridge Investments. Michael, thanks for being with us. You saw some of that heated debate before the break between Rick and Steve. And your notes, I'm reading, surprised that investors continue to be caught off guard, talking about the consensus for rate cuts. Who's at fault here? Is the Fed's giving mixed signals? Is the market not pricing this correctly? What's going on? And are markets resilient? I mean, I had a guest last hour who said that they should be down way more today.
Yeah, I think we are surprised that investors continue to be surprised, right? We've been playing this game now for almost a year and a half of when's the Fed going to start to cut, and it keeps getting delayed. And I think the reason people keep getting it wrong is largely because the reference point is the last 10 years, the 10 years maybe after the great financial crisis, when interest rates were abnormally low. And if you look back over a long period of time, right, what's unusual is not where interest rates are now. 4.5%, 5% is not particularly high based on any long-term history. What's unusual is where we were in the 2010s. And I think people got habituated to that, such that when rates moved higher, they expected them to go back down again. But the world's changed a little bit, right? You had COVID, you had many trillions of dollars of stimulus, you have the energy transition, you have less trade with China, all these things that could just be leading to a world that is a higher inflation world than we were in for the last 15 years. So
are you saying that the 10-year yield isn't the appropriate metric to look at anymore? What is?
No. I think that the 10-year yield is the appropriate metric. I think, though, that everybody's conversation is when's it about to go down because they think it's unusually high. We're saying we don't have a crystal ball. We're no better at forecasting the future than anybody else. But instead of just waiting for the next cut, we're trying to embrace the idea that maybe we're in a higher interest rate environment for the next many years than we have been for the last 15 years.
You've got three areas where inflation is notably sticky. One is energy right now. Number two is rents. Number three are services inflation.
Yeah.
I guess the question, I'll go back to what I asked Lindsay Piegza in the prior segment. Did the Fed err in not raising rates higher than they are today to go that extra mile to wring inflation out of the system?
I think the jury's still out on that one. The Fed was clearly late to the game in raising rates.
True.
But
then it raised very aggressively.
It did. And I think now we're at a level where probably patience continues to make sense, right? We're not at this 8 or 9% rate. We're at a 3.5 or 4% rate. And I think you can't just look at inflation in a vacuum because...
Does it surprise you that this last mile on inflation is being as stubborn to navigate as it seems to be?
I'm not a PhD economist.
Yeah,
but
okay.
So when I take a step back, it doesn't.
Neither am I, and I opine all the time.
What's interesting is I think we all see the headlines about what's happened with wages, right? UPS raised wages, 40% last summer, and the car companies are raising wages. So I'm sort of surprised that people keep thinking that inflation is going to drop back down so much when we all experience it every day.
Wages actually outstripping inflation right now.
Absolutely. But that's a double-edged sword, right? That's not good for inflation and interest rates and investors, but it's good for workers. And so we're seeing that in a more robust and resilient economy.
And exactly, like you said, a more resilient economy. So what matters more for equities? What do you do here? If you don't get perhaps as many rate cuts, but you have a strong economy, how does that play out?
Yes, I think that's one of the things that that's been tough for people to make sense of, right? We're so used to that, the idea that if earnings are continue to grow because the economy is resilient, that's going to be great for stocks. But we have this other headwind now, which is interest rates. And so I think what we're trying to do is take advantage of areas where there's been less attention that have maybe been overlooked. And there were several sectors last year where they started to discount higher rates and underperformed, and there's opportunities today. So, for example, we like consumer staples here, right? Inflation, it continues to be more sticky than we'd like. We focus on companies with the ability
to dividends.
We like dividends.
You like dividends.
Dividends are critical. Dividends are critical in a world of higher interest rates and higher inflation because the only way you can keep up with the higher cost of living is if your cash flows are growing in excess of that. So you can find high-quality dividend growers that are growing their dividends 8, 9, 10% a year, and that's well ahead of inflation of 3 or 4%. And so your purchasing powers continue to grow. And we think that's critical. And so we think dividends have been overlooked for a long time. And in a higher interest rate, higher inflation environment, they're going to be important. And you really want to focus on companies with the ability to grow dividends in excess of inflation.
We have to leave it.